Nullzinspolitik, ausufernde Staatsschulden und hohe Volatilität an den Aktienmärkten lassen die Investoren nach Alternativen Ausschau halten. Vor diesem Hintergrund hat Gold, das älteste Wertaufbewahrungsmittel der Welt, in den letzten 12 Monaten über 30% zugelegt. Aber wie geht es weiter? Gibt die fortgesetzte Nullzinspolitik der wichtigsten Notenbanken realen Werten und damit Gold weiterhin Rückenwind? Diese Fragen wollen wir gemeinsam mit Jupiter Asset Management beantworten. Hallo und herzlich willkommen bei Fonds im Fokus und dem Thema Goldrenaissance, Investoren entdecken den besonderen Wert von Gold. Zugeschaltet dazu aus London ist Naylor-Leyland. Er ist Fondsmanager im Gold- und Silberteam von Jupiter Asset Management. Hello Ned, nice to see you.
Nice to see you too.
Das Interview führt Wimmer, Senior-Analyst bei FondsConsult Research. Herzlich willkommen hier im Studio, Herr Wimmer.
Grüß Gott.
Ich freue mich auf ein angeregtes Gespräch. Bitte sehr, please.
Vielen Dank, Herr Schmidt, and a warm welcome to Naylor-Leyland. You launched the fund in 2016, and you are nearly 20 years now in business with managing precious metals. How did the idea of launching this fund come about?
The fund idea really came from an observation that the opportunities for long-only investors in gold, in silver, in mining, in my view, were suboptimal. They could be improved upon. So I suppose that the fund really is a bespoke solution for today's market. So what I mean is it's not a suit bought in a shop. It is one tailored for the environment we're in, which is why it looks a little different in its asset allocation model, its processes, and also in the way that we speak about it.
Do government fiscal programs not only compensate for the lack of demand, and is monetary policy not only responsible for creating asset price inflation, which we can already see?
I think the key thing to understand here is that gold and inflation is not a thing. Gold and real interest rates is absolutely a thing. So what I mean is that it's that relationship between interest rates on one side and inflation on the other, and the interplay between them. That's what drives the gold price. So negative and falling real interest rates, which could be rising inflation or falling rates, is what drives gold up and silver up. So it doesn't necessarily need to be rising inflation. It could be the continuation of a zero or negative interest rate policy that drives gold, if you follow my rationale.
What sets you apart with your fund from competitors, especially within the gold mining equity fund space?
Principally, I suppose there are two differences there. One is silver. You know, we have half of our portfolio in silver. We obviously own bullion as well as mining equities. We carry a weighting, always a weighting to physical metal. But at the moment, about 50% of the portfolio is in physical silver and silver mining equities. That is very different than what else is available. We also make more, I think we make more qualitative judgments than other funds. We're not at all benchmark oriented. So we don't invest in Africa, Russia, Central Asia, anywhere like that, because we believe that the operating variables are much more complicated in those jurisdictions. And gold mining companies are already full of complicated operating variables. So we refine our universe. It's quite narrow, and we have a heavy overweight to silver. Those would be I suppose, the main differences.
Why do you combine gold and silver, and likewise a flexible allocation between gold and silver mines?
Silver is a great opportunity. Silver is a beta play on gold. You know, they're both driven by real interest rates and by participation in wider markets. So if capital is flowing towards gold, silver outperforms. Optically, it looks like silver may be driven by its industrial demand, but it's not. It's driven through the monetary channel, just like gold is. So I believe it's very obvious that silver is a very helpful portfolio tool to drive attribution and return. Also, it's worth mentioning that, I mean, silver is only at about half of where it was at its highs in 2011. And silver, gold, of course, is challenging that all-time high level, which means silver has much more upside. And silver miners similarly have lower operating margins. So they inherently have more potential for the next leg of the bull market than the larger gold mining stocks that we tend to avoid, particularly in light of the bullion that we have in our portfolio.
In which boundaries do you control the allocation between gold, silver, gold mines, silver mines in your fund?
Principally, we have two models. So if we're in our bullish model, then we can be 70-30 in favor of silver. I'm never going to get there. That's a mandate number. Realistically, at 60-40 in favor of silver, I'm going to be selling silver assets consistently because it will be the outperformance of silver that has driven me from a current level of about 50-50 to 60-40, and that will put me on the offer mainly in silver mining equities. In order to retain around a 60-40 balance, we have a bit more scope, as I say, in the mandate to go to 70-30, but I don't anticipate needing to go that far. We have to have 15% in bullion at all times. We also don't get as low as that. So really it hovers around 17 or 18% in the bullish model. And then we do have a defensive model, which the idea there is that we're dialing the volume down. So rather than dialing the volume up in bull market conditions, when conditions require it, we're going to dial the volume down, and we can be up to 50% in bullion and down to 30% overall in silver, similarly to what I said in the bullish model. And that is, as I say, designed to manage the cycle on behalf of the clients. So not to be just, very long operating gold miners in all scenarios, because that's not helpful for a long-only investor.
Can you please explain how it is possible to hold physical gold without being an alternative investment fund? There are some investors outside who are not familiar with a bullion fund.
The bullion funds that we use are listed equities that trade in Toronto and New York. So really they are similar, they are, if you look at them from above or from the side, they look quite similar to exchange traded products, although they have a higher legal structure, better custodial practices, and there are various nuances there that make them better investments for long-only investors. And actually, to give you a sense of still how low sentiment is even now, one of the silver bullion funds that we buy, as I speak to you today, that product's trading at a 4% discount to its NAV. So in fact, we're buying more of it today. So being able to buy what I consider to be the risk-free instruments of our whole financial system for a 4% discount is quite attractive.
Can we mention a few words about the selection of the single stocks in your fund? How is the investment universe being selected, and how many holdings do you have in the fund?
So we have various different ways of filtering our investment universe down. Normally when you think about gold mining funds, it will be a universe of 400 or 500 stocks, and people will be making selections within that. Our universe at the moment is around 120 to 130 stocks as we see it. The first filter that removes a good proportion of opportunity is geography, as I touched on earlier. So, we're invested in the Americas. That's Alaska to the bottom of Chile, Argentina sometimes, and then Australia is a big overweight. Those are the geographies that we want to be invested. So that removes a high proportion of the investable universe straight away. And then we look at the track record of management teams, because that's very important in the long run, whether management teams have delivered against guidance and investor expectations. That's something else which can filter out some opportunities. And then further to that, what we would call an asset inventory process. So a lot of mining equities hold assets which have been seen through other cycles. So we have models on them. We know whether they're likely to work and be interesting in this current market condition. So that will also remove some. That leaves us with this 120, 130 stock universe. And then we end up with currently we have 36 mining equities in the portfolio, and we'll have different subsets within that. So some silver producers, some gold producers, some development assets in tier 1 jurisdictions, principally Australia at the moment is a very interesting place to be invested in development and even in exploration. So each of those are subsets that we populate with the opportunity set which we have filtered away in the first place.
Do you invest only in big companies or also in small cap and exploration firms?
We don't buy the biggest gold mining companies. We don't own your Newmont or Barrick. We seek to hold physical instead of those. They look very much like benchmark weighted positions to me, and I would rather own physical metal in that part of the portfolio. So we tend to then focus on the second tier producer that sits just below that, mid caps. And yes, we do have at the moment about 8% of the portfolio in exploration. Now, exploration is very interesting because for 20, 30 years, there has been very little capital available for drilling. Now, some people may think that should put them off, but actually we see great opportunity there because exploration geologists have been identifying where they think the next big assets are for many years. They simply have not been funded to go look for it. And in the last 12 months, this has worked quite well for us. And we think it will carry on that direction, particularly as the very biggest gold mining companies, which we don't own, have a structural problem with reserves. So there is a real need for new discoveries, new assets to be developed. And we think that there's a very specific opportunity there, so long as you're in the right jurisdiction.
Let's have a closer look to your current portfolio. What does your allocation look like? And what is your scenario? Bullish, bearish, or something in between?
No, I mean, so we're very firmly in the bullish model and have been for some time now. And that leads me to be tilted towards the bullish model. We have about 17.5% in bullion. Within that bullion weighting, we're slightly overweight silver to gold, but only slightly. And then in the rest of the portfolio, again, quite evenly split. So we're looking just over 40% in gold miners and just over 40% in silver miners. Although it is worth commenting that what we would call a silver miner is almost always mining gold and silver. So actually at revenue level, they're kind of 50-50. So while I say I'm 40% in silver miners, that's nomenclature, that's the naming rather than the pure outcome, if you follow my point.
One point to your current portfolio, what are your biggest weights in single names in the portfolio and why?
So we have two stocks that I would mention. One is Pan American Silver, which is, we think, the highest quality silver producer in the world. It's now paying a small dividend. It has mines in a number of different countries. It has good capital discipline. It's worked both bull and bear cycles successfully. And it also has scale and growth potential. So it has scale, and that's important because probably in the next layer of this bull market, you'll see investors certainly initially seeking out size, as we saw back in May and June in the gold sector, where the very biggest companies did best initially. But growth-wise, they have some very big projects which really represent almost nothing in the current net asset value of the stock. And that's something that we look for. We want a pipeline of projects to come in and not necessarily have the need to do M&A to make acquisitions in the next part of the cycle. What we want to hold are things that will be bought. Now, having said that, that brings up the second thing. So we have a very decent sized position in an Australian exploration, development stock now really, called De Grey Mining, which is a reinterpretation, I suppose, on a geological basis of the Pilbara region of northern Western Australia. And it has grown in our portfolio very nicely. We think there's a lot more to go for there. It's a very, very interesting discovery.
The silver price also showed a very high volatility this year. How do you judge the price movements and how did you act?
Well, look, again, our asset allocation model captures all of this, and we want to be there for the optionality that silver gives you. I have very, very strong expectations of the silver price over the next few years, and it will be volatile, I think, but with a very powerful upward bias. Now, so long as the asset allocation model is well thought out, you should be able to ride that process. And like I just said, ideally, what we want is silver to run, and that to drive us to be on the offer in silver equities, to be a provider of liquidity in the market for silver equities. And that's really what we've done, is we've accumulated a large number of the most liquid and best run silver mining companies. And if the thesis about silver doing better yet than we've seen this year comes to pass, that will drive our asset allocation model towards an area where we will need to do that, and we will be there on the offer, benefiting from spreads rather than being hurt by them, which is often the case in this sector. We should be there to benefit from that.
The oil price is another very important commodity and is a major cost factor for mine operators. How do you rate this after the oil prices slumped? And where do you see the break-even price in production for gold and silver mines at the moment?
On an individual case basis, it's difficult to answer that because every company is different and every mine is different. So I'm not sure that I really want to get involved in giving you one number. But what I will say is, respect of oil, this is a very different market now. We've always seen, certainly in my career, a situation where when gold does well, oil is usually trending higher quite dramatically. That tends to reduce operating margins for mining companies. So while the gold price might be going up, their costs are going up with it, and that's difficult. Suddenly, we're not in that situation now. I do think that oil will be volatile, and I'm certainly not going to start making predictions about where it will and won't be, particularly in a difficult geopolitical environment where that can always come along and make an idiot of anyone making predictions. But what I will say overall is that costs in mining are far more manageable now than certainly they were in the super cycle. So if you think about the commodity super cycle, services and equipment and people were much more expensive, and they kept getting more expensive. Energy went from $20 to $120 a barrel oil. And we also, importantly, we had a weakening US dollar versus mining currencies. So, you sell gold and silver in dollars, but your costs are often local currencies. So in Mexico, for example. Now, actually, a weakening dollar is a bad thing, not a good thing for gold miners. Some people think that a weakening dollar must be good, but actually it's a problem at a structural level. And what we see overall is that oil looks pretty good, FX looks pretty good, and I would say that the equipment, services and people side looks pretty good too. So overall, it looks quite well set for the next few years.
Let's talk a few words about ESG and the impact on the asset management industry and investor behavior. Do you notice an effect in slowing investor demand as the mining industry is facing environmental issues?
I wouldn't say so. No, I think that the ESG, it's important to bring this up. In our world, it's a fully integrated part of the investment case. It really isn't an add-on at all. Think about the fact that I said to you that we don't invest in Africa, Central Asia, Russia, etc. Some of the reason is what I said, which is pure operational, and some is because social licenses and environmental permitting can be an issue in some jurisdictions. Now, if you don't have that well covered off when you're making investments in gold and silver mining companies, that can be very powerfully bad news for you on an investment level. So it has to be fully integrated. And, we have a charter and we have a screen, and all of this is very much integrated in our overall investment process.
Precious metals and equities are a volatile asset class. What do you see as a suitable weighting of your fund in a customer portfolio? And what is actually the weighting in your personal portfolio?
I'm a gold bug, so I don't own much else. I'm very much somebody that sees gold as, I probably said this earlier, the risk-free instrument of the system. And I always want to own a lot of the risk-free instrument of the system. So you can be confident that I have a very high proportion of my net worth in the fund and in physical gold and silver. Now, that's not necessarily appropriate for everybody, particularly in the way that modern portfolio management functions. So to answer your question in a sensible way, I would draw reference to academic studies which look at portfolio returns over the long run. They say that 2 to 5% is a good solid allocation in all market conditions to gold. But I would bring a certain thing up, which is why we run the fund the way we do. That does not take account for what is happening at central bank level. So those studies look backwards in a linear way, and they don't capture the most important problem in financial markets, which is the monetary system. And it's a very profound and worrying thing, and people are concerned about it. So the nature of our fund and the way that it's layered, you could hold a similar quantum, a 2 to 5% allocation. It will be a bit more volatile, but it can capture and run in a sort of call option way against that issue in the monetary system, the same way that physical just simply won't do that, because physical gold is money. It's FX, it's currency. What it won't do is turn from Clark Kent into Superman in your portfolio.
Ned, why should an investor buy your fund now? And what performance potential do you see for the coming 12 months?
Well, I'm not comfortable making a prediction on potential performance for the next 12 months, but timing-wise, it's very interesting to talk to you today because the banks have just completed their usual annual option expiry washout in the gold and silver prices. And seasonally, this happens pretty much every year. Usually the period from now through till February is a very strong one for gold and silver prices. And a good proportion of the reason for that is because the banks have successfully managed to get gold back to $1,800 an ounce recently, meaning that these options all expire worthless. So I think short-term timing-wise, now is a very interesting time to look at it. But most importantly, it's because we're about to get policies from the US which are profoundly negative for real interest rates. You know, we're now in a world where things that I've talked about for 5 years, like modern monetary theory, a new Green Deal, and the likelihood of yet more enormous central bank balance sheet expansion is very close at hand. And I will say something important here. I think it's quite clear that when we leave behind the level that gold hit in 2011 and the level it hit in August, so that sort of $2,000-ish level, when that's left behind, the whole market will want to participate. It's quite reasonable that we're in a bit of a soft zone right now. It makes sense to me. But I think that if you look back at 1979, 1980, when gold and silver had a very, very big move in quite similar macro and sociological conditions, that it will be leaving that number behind. That will make the broader market look up and say, hold on, this is actually happening now. So I think that now is quite a nice moment because it's before that happens.
Ned, many thanks for your explanations about your fund. I learned you are excited for the investment theme and you are fully identifying with managing this product. I wish you a lucky hand with your investment decisions and good results for the coming time. Thank you, Ned, and bye.
Thank you very much. It's been very interesting.